A massive week for traders is behind us. Donald Trump took the election by landslide, and we saw the FOMC and Bank of England cutting interest rates by 25 basis points. However, there's plenty to play for, and we've got the likes of the US CPI, the jobs report out of the UK and out of Australia, all to look forward to for the week starting Monday, the 11th of November. So here is the breakdown for the big ticket items according to Trading Economics, starting off on Tuesday with the jobs report out of the UK, ZEW economic sentiment out of Germany. Also on Wednesday, we've got the CPI report, inflation from the US with an expectation that we see core at 3.3 and headline up to 2.6. In terms of Thursday, we've got a raft of UK data points headed up by the GDP figure. We're expecting to see declines across both quarterly and annual GDP and monthly for that matter. And then rounding off the week with a focus on China, industrial production, retail sales, and then retail sales out of the US. And kicking off with the US, like I said, Wednesday, we've got that inflation report. Of course, everyone always says the Federal Reserve cares only about the core PCE price index. Well, that's not necessarily the case when it comes to markets. They care about both CPI and the core PCE metrics. And you can see here in terms of headline inflation, the expectation is we're going to see a move upwards this time around. And that could really start to rein in rate cut expectations further. Of course, we've just seen a week where Donald Trump has come into power. His victory in the election paves the way for stimulus packages that could spark inflation. And this idea that Donald Trump is inflationary has seen markets essentially rein in their expectations for interest rate cuts going forward. If we see a move higher in terms of inflation here, that really would highlight the possibility that we need to see the Federal Reserve taking a more cautious approach. Of course, we've just seen the FOMC meeting. They cut by 25 basis points. That was expected. But what do they do going forward? Markets undecided, and essentially this CPI report should give us some guidance on exactly where we go from here. Retail sales also notable on Friday alongside industrial production. Of course, Donald Trump will hope that he can lift both sides of those metrics. In terms of US inflation, what's notable is that the last CPI report saw downside in terms of the likes of shelter, which is a third of inflation and essentially a lagging indicator. But we saw upside in terms of the core metric driven by services. You can see the purple line, services excluding shelter, up. You can see the green line, core excluding shelter, up. So essentially shelter has gone from dragging inflation higher to being the thing that's helping to try and drag it lower at a time when we've seen a resurgence in terms of services. So that is going to be the key part of it. Do we see services inflation rearing its head once again? And that really would provide the basis for people to be more cautious going forward for what we're going to see from the Federal Reserve. And as you can see here, the expectation for the next meeting signals a strong chance that we see a rate cut, but not a given. Markets now pricing a circa 25% chance that we don't see a rate cut in December. And you can see here that a month ago, people were talking about a 50 basis point cut. This time around, now at best, you're going to get a 25 basis point cut. And essentially, you're looking at the possibility of that number increasing from 25% for a pause from the Federal Reserve if we do see a significant rise in terms of inflation over in the US this coming week. Now, in terms of the S&P 500, this is a market that certainly has been outperforming of late. US markets really booming off the back of this Trump trade news, taking us through into record highs. And so what we want to look out for here is, do we get a pullback at any point, right? Or are we just essentially continuing to play out? So you can see the election rally has lasted 3 days. We're starting to see a bit of weakness. If we see this roll over, it would need to take out your near-term sort of swing lows. The most notable would be 58.73, but below here, you're looking at 59.57, 59.23. If we start taking out any support levels, we could point towards a short-term period of weakness. But certainly this is a market that is outperforming. So it's going to be really interesting to see if we see inflation actually do better, so come in below expectations, expect further upside for the S&P 500. The flip side is if we see a strong surge in inflation, we could see some of this strength curtailed, albeit for the short term at least. In terms of the next area we want to talk about, it's the UK. And the UK, of course, has also had a central bank meeting, the Bank of England cutting interest rates by 25 basis points. But the UK also has had a significant shift in terms of the outlook for fiscal spending, much like the US. In the UK, we've seen a raft of tax hikes trying to pay for this raft of fresh spending. And we've seen a recalibration on how they essentially calculate their borrowing levels to be able to free up more cash. That by its nature, much like the fears that we're seeing over in the US, is inflationary. So the Bank of England, essentially, they're saying that they need time to be able to gauge exactly what the repercussions will be from this latest budget. But certainly that's kind of put people off the idea that we're going to see a December rate cut coming into fruition. This week, we've got the jobs report on Tuesday. Expectation that we see higher unemployment, higher earnings, and lower employment change with a negative 50K reading. So a bad report expected pretty much all round. Certainly higher unemployment, a negative employment change metric. Those are the kind of things that could push the Bank of England to act. But certainly we need to see wage growth come down because those underlying inflation metrics are going to be absolutely key for them to gauge where we go in the future. And the expectation that we move from 3.8 to 4% isn't necessarily going to help the idea of us cutting rates in December. Then on Thursday, we've got even more data coming out. GDP on a quarterly, a yearly, and a month-on-month basis. What we're expecting, weaker figures across all three of those metrics. So clearly there is a need for us to stimulate the economy. Also look out for the goods data, goods trade balance. This is an interesting one because if you watched our live stream around the US election, make sure to check them out. There's a huge amount of data in there. Part of that showed that the UK actually has a deficit to the US, unlike many of the other trade partners to the US. And that stands the UK in decent stead to be able to strike a trade deal with Donald Trump. Quite whether or when that will happen, it remains to be seen. But certainly that is notable. Industrial production expected to decline. Manufacturing is expected to decline. So all in all, we're expecting a bit of a shocker. Here's the real GDP rate for the UK compared to some of the other developed nations in sort of North America and Europe. And we can see here in terms of the UK, it's in the blue line, floundering somewhat. You know, you're below that, you're only really looking at a couple of countries. Germany has been the standout. It's essentially where it was pre-pandemic. And we know that Germany has really struggled in particular, and also Japan. And above that, right at the top, is the US. So running away with it, really, and Europe in particular flagging, with the UK stuck in the middle there somewhere. In terms of wages, of course, the wage data, the average hourly earnings that we see within the jobs report is going to be really key, because as we see here, we're seeing that earnings metric coming down. That is providing downward pressure for the inflation metric, currently headline CPI at 2%. But notably, we can see here real earnings at 2.8%. And the longer we stay above that zero mark, the better it is for the economy, the better it is for people's pockets, and they're going to be able to spend more. But it's starting to roll over. So certainly look out for the earnings figure. The expectation is that we see it actually move towards the upside. So stubbornly high wage growth could be a concern and could be grounds for caution from the Bank of England. Here's the outlook for the Bank of England. December, now only a 20% chance, essentially, of a rate cut. And so this slower pathway for rates could be a concern going forward. You can see here an expectation that we pause this time, then cut in February, then pause in March, then cut in May. So it's every other meeting. That's what markets are now looking for. And the data that we see over the course of this week will be key in telling us exactly whether that is likely or not. Here's the chart for cable. We can see here on the weekly time frame the relative yields for the UK 10-year versus the US 10-year do point towards the possibility of a pop for this pair. You can see a rise in terms of the UK 10-year against the US of late, not necessarily being mimicked by cable. But if we look at cable, let's just bring this up over the shorter term. We can see that over the last, say, 6 months, we have this very clear upward trend in play. So we've got sort of mid-sized retracements, we've got deep retracements, and then we've got the current move. And the current move has taken us all the way down to the 76.4 fib. We've tagged it on 2 occasions. One time was after the election, and we found some support. Now, the key thing here is that, yes, the election has provided significant strength for the US dollar, but we're also seeing hesitancy here in the UK. And if we see strong inflation data coming out or strong wage data coming out and things that reiterate the point that the UK is not going to be cutting rates at a quick pace, that could provide the basis for strength. As you see here, though, on the 4-hour, that we're continuing to create this pattern of lower highs, and that has remained in play with the fact that we've rallied up from the 76.4 fib, but we've then come into the next 76.4 fib here, right? So crucially, we need to break the 1.305 mark to be more confident that this market has bottomed out, because if we look over the near term, we're of course within this bearish phase set within a wider bullish phase. So we've got a couple of 76.4 fibs that we're essentially trading within, and which one breaks is going to be absolutely key as we go forward. And finally, this is the outlook for Australia. A host of key data points, notably Wednesday, we've got wage data. Thursday, we've got the jobs data. It comes off the back of the RBA decision to pause once again on rates. And markets are expecting them to do that for some time. They're relying on data dependency. And essentially, that data dependency points towards them likely holding out for some time yet. Inflation isn't where they need it to be quite yet. And so some people are saying, well, this could mean the back end of 2025. Some people are saying it could get us into 2026. It remains to be seen. But certainly this is a key market to be looking out for. And notably, if we're looking at the data, we're looking for employment change to come off. We're looking for wage growth to actually come off on the quarterly basis, rise on a quarterly basis, but come off on the year-on-year basis. And that highlights this chart, right? So we've got wage growth has remained stubbornly high around that 4% mark, despite the fact that we clearly topped out in terms of inflation. So inflation should usually essentially inform people in terms of their expectations for wages going forward. And so we need to see wage growth rolling over. If we see that, then we can feel a little bit more confident that that's then going to continue to drive inflation down. And then we see a shift from the RBA. But until that happens, with inflation still above target, with wage growth still stubbornly high around the 4% mark, there is a concern that the RBA is going to have to just keep waiting and waiting and waiting. Another area that could be a reason for strength is that manufacturing as a percentage of exports for Australia is remarkably low compared to many of the other major trade partners for the US. And when we're talking about tariffs on goods from Australia, it's unlikely to hit them in a particularly meaningful manner compared to some of the others, some of the other countries that have seen significant weakness off the back of this election. And certainly the Australian dollar's actually held up relatively well. This could be a reason for it. Here's the expectation for the RBA. When are we going to see the rate cut? Well, April is a coin toss, and then you're looking for the most confident view as a rate cut in May. That's some way away from where we are at the moment, and certainly that's well behind some of the other currencies out there. Let's look at the likes of the euro against the Aussie dollar, in part because of the fact that the euro, of course, they're expecting to continue to cut rates. We're not seeing any reason for them to slow down the pathway, coming at the time when the likes of the UK, the likes of the US are looking to take a more cautious approach, and Australia continues to take a cautious approach. Well, the 4-hour chart shows you the declines that we've seen over the course of this week thus far. We have seemingly bottomed out for now, but I do think there's a good chance that we do continue to see the bears in charge. Certainly would feel great confidence with such a move if we take out this low here, 161. But if we look at the hourly time frame, you can see here this downward trajectory does point towards a possibility that we're essentially retracing this intraday move here. So look out for Fibonacci resistance where we are at the moment, which is 1628, and then above that at the 76.4, which is 163. So a break up through this 1636, that would give us greater confidence that the bulls are going to remain in charge. But at the moment, there is still a risk that we see this roll over despite the pop we're seeing at the moment. And certainly if the data points towards a need to continue to be cautious at the RBA, then that could provide us with another downside move for the euro against the Australian dollar.